In this video, we'll do an in-depth analysis of Domino's Pizza stock. This video is intended for someone who wants to learn more about Domino's prior to investing or trading. That way you can trade or invest with a greater level of confidence. I chose to analyze Domino's because I'm considering buying the stock, and this analysis will determine whether or not I do. We'll look at how Domino's operates and earns revenue according to their annual report. We'll cover pros and cons, competition, fundamental and technical stock analysis. We'll also determine if now is a favorable time to buy the stock. To begin, we'll head to the annual report or 10K for Domino's so we know we'll be gathering accurate information. Domino's is the world's largest pizza company with roughly 19,800 stores in over 90 markets around the world, including but not limited to India, the UK, Japan, Mexico, and Australia. The majority of their stores are international at 66% of total stores, but income is primarily generated in the US at 51%. In addition to their core business, which is pizza, they also sell sandwiches, pasta, chicken wings, and dessert. They also tailor their menu to international markets and offer pizza with toppings such as octopus bomb shrimp in Korea. They operate in a restaurant category called quick serve or QSR. Restaurants in this category, including Domino's, offer casual dining services, takeout, and delivery. This is a key feature of their business, which reduces their overhead through not having to provide table service. Domino's is almost entirely a franchise business, with 99% of their stores globally being franchised as of January 2023, which we'll come back to later in this video. The primary categories by which Domino's earns income is broken down into three main segments. In descending order, they are U.S. stores, international franchise, and supply chain. Supply chain refers to the products and food needed to operate a restaurant that are supplied to the franchisee from corporate, including ovens, dough, and cheese. From 2019 to 2021, Domino's had a net growth in U.S. stores of 9.1%, growing from 6,126 stores to 6,686. Internationally, during the same time frame, they grew their store count by 21.1%, growing from 10,894 stores to 13,194 stores. Now we'll cover the pros of the business. The most obvious pro is that they serve food. Food is an essential item, and even through an economic downturn, people will still eat. Additionally, Domino's is primarily a takeout and delivery business, which reduces cost of operation, leading to greater restaurant viability for the franchisees. This leads me to another point that creates a seemingly endless stream of income for Domino's, which is that 99% of their stores are operated by franchisees. So as a store creates revenue, Domino earns a portion of that revenue as income, while at the same time, if the store fails, Domino's won't suffer the same loss that the franchisee will. This protects the shareholder and makes the franchisee bear responsibility of the restaurant. Another benefit to this business is that it represents convenience in multiple ways. First off, customers can order through their app from the comfort of their home, and this aligns with the overall growing trend of home delivery and our human desire for convenience. The Domino's app is also a great feature to create a consistent customer base, as it offers rewards based on purchases and timely discounts. Not to mention that their app enables customers to track their order from creation to delivery. This feature reduces anxiety about delivery time and enables customer comfort. Furthermore, if you've ever sold a stock because the price went down and you didn't understand the business, you can sleep well at night knowing Domino's is operating with minimal complexity, selling food while you sleep. Looking from a macro view, Domino's is continuously opening stores around the world, while at the same time historically reducing number of employees. This will inevitably lead to a higher bottom line into the future. Now we'll get into the potential cons of owning Domino's. First con that popped into my head while doing this analysis was that health food is trending, and pizza is a big glob of delicious, fattening cheese, not generally considered healthy. For this reason, many quick-serve restaurants are in lawsuits with the claim that they have failed to disclose health risks associated with high-fat foods, and that their marketing practices have encouraged obesity. This litigation could continue across multiple markets as they are so well diversified internationally. Another potential con to the business is that as society urbanizes, there will be more food choices, and customers could find another better pizza than Domino's. Lastly, there's a social upheaval against so-called big business, and there is a stronger and stronger sentiment wanting to support small businesses, especially in the food industry. Now we'll get into the competition for Domino's. The main competitor that operates at nearly the same scale of Domino's is Pizza Hut. They operate in more than 100 countries and have 19,000 stores. Although Pizza Hut is a subsidiary of Yum! Brands, who is the parent company for KFC, Taco Bell, Pizza Hut, and The Habit. There are no other pizza companies that operate at the same scale internationally, and you can't buy Pizza Hut outright, so Domino's is the largest pure-play pizza company in the world. Domestically, the next biggest competitor to Domino's after Pizza Hut is Little Caesars, which is growing at a similar rate to Domino's and also has the benefit of not having in-store dining. Although you can't buy Little Caesars outright either, as they are held by the holding company Elitch Holdings, who also owns the Detroit Red Wings and the Tigers. Otherwise, Domino's competes with every other pizza restaurant in whatever market it operates in. Additionally, frozen pizza could be thought of as part of Domino's competition. I think if there were to be a severe enough economic downturn, frozen pizza would see more growth than restaurant pizza. Now we're going to cover a few key financial metrics that I find most important, including revenue, net income, free cash flow, profit margin, cash, debt, shares outstanding, and dividends. We'll start with revenue per share. It is the first flow of money into a business. I like to look at 5 years of data because it gives a relevant but longer term picture of company performance. Both of the software websites I used didn't have data for 2020, so we'll calculate the growth rate using a 6-year span. From fiscal year 2018 to 2023, Domino's grew their revenue per share at a compound annual growth rate of 7.3%, which is strong given their large scale. Now we see net income per share from 2018 to 2023, which grew at a CAGR of 6.3%, which isn't too bad. Here we see free cash flow per share from the same period, which grew at a CAGR of 8.6%, outpacing revenue and net income, which indicates margin growth. Here we see profit margins, which were growing historically but have recently tapered back to around 10% for this period, which is strong for almost any company and especially for a food company. Now we see cash and short-term investments. I like to use this metric as opposed to assets, as there are many assets not likely to be sold and are non-functional to the company. Cash and equivalents, on the other hand, can be used for investing activities like share repurchases, dividends, and paying down debt. From fiscal year 2018 to 2023, Domino's has grown their assets at a CAGR of 15.5%, growing from $25.4 million to $60 million. Now we see total liabilities from 2018 to 2023, which has grown at a CAGR of 6.6%, growing from $3.9 billion to $5.8 billion. But we don't want to look at debt in isolation. We want to compare debt to net income so that we get a sense of how impactful their debt load is. As of January 2023, their debt to net income was 12.8 times, meaning that if their net income were to remain the same, it would take 12 years to pay off their debt using net income, assuming no other costs. This is one of the higher levels of debt to net income I've ever seen when considering buying a business, and is cause for concern. Now we see shares outstanding. This is one of my favorite metrics and is generally indicative of company wellness if share count is consistently trending down, unless the company is repurchasing shares with that alone. Domino's is doing exceptionally well in this category, reducing their share count by 16.7% from 2018 to 2023. Lastly, we'll look at dividends, as Domino's has historically been a dividend growth company, growing their dividend by a staggering 14.9% from 2018 to 2022, not including their most recent dividend. If this growth were to continue into the future, as it has in the past, owning Domino's will lead to having a substantial yield on cost, which is a fair assumption to make given their average payout ratio over the last 5 years was only 27%, and their maximum payout ratio is only 35%, although as of April 14, 2023, their current yield is only 1.5%. Now we'll compare Domino's to some of its peers and to its history using fundamental metrics to determine a sense of value for where Domino's is currently. Here we have Yum! Brands, which is the parent company to KFC, Taco Bell, Pizza Hut, and The Habit. And we have McDonald's, which is another predominantly franchised international food company. Here we see each company compared by the price to earnings ratio over 5 years. Currently, Domino's is the least expensive stock at a PE ratio of 26, followed by Yum Brands at 29, and McDonald's, which is on a totally different valuation level of 34. Now we see Domino's in isolation with its PE ratio graphed, and we can see that 25 is around the lowest PE ratio that Domino's has reached in the past 5 years, and is currently bouncing off that valuation level. This indicates a relative value given this 5-year time frame. Now we see a total return chart with Domino's, Yum Brands, McDonald's, Eats, which is a relatively new restaurant ETF, and the S&P 500, as these are all comparable potential investments. In terms of total return, the best performer of the group is McDonald's, with a return of 100%, followed by Yum Brands at 70%, S&P 500 at 68%, Domino's at 47%, and lastly the Eats ETF with less time data at negative 18%. This recent poor performance and undervaluation could be indicative of a buying opportunity for Domino's. Now we see a 5-year chart for Domino's, and the first feature to observe is the price trend over this period, which is moving in the right direction for someone looking to buy a long position. The next study we have displayed is the standard deviation chart. Ideally, we want to be buying at the bottom of the standard deviation channel, indicated in green, and selling at the top of the channel, indicated in red. Evaluating with this tool, Domino's is currently at a favorable time to buy, given its closeness to the bottom of the channel. The next tool to observe is this resistance level that has acted as price support historically and is now acting as resistance here at around $330. The final tool I use to determine value is the Relative Strength Index, or RSI, depicted here. When this white line is at the bottom of the channel, it is a more favorable time to buy, and when the line is at the top, it is a more favorable time to sell. In this case, the RSI isn't giving a definitive buy or sell signal. In conclusion, Domino's is relatively inexpensive on a fundamental basis in relation to its history, and is also inexpensive on a technical basis and indicates a relatively favorable time to buy for this time frame, given the metrics we've used to analyze the company, although there may be a slight pullback to around $300 in the short term. If you want to gain access to the trades that I take, feel free to join my Patreon, linked below. Thank you for watching.